All right, traders, in this video, we're going to be talking about SoFi, selling put options on SoFi. It's probably one of my favorite stocks to sell put options on right now. And I get a lot of questions. People ask me, Lee, what's one of your favorite stocks to sell put options on right now? And what do you have for smaller accounts, like say under $5,000 or $10,000? So in this video, we will be talking about selling puts on SoFi. It is one of my favorite stocks to trade right now, to actually sell put options on them. I'm going to talk about what selling put options are. We're going to look at the option chain. We're going to look at the probability calculator. We're going to look at the charts to see why I like selling puts on SoFi so much. So if you're interested in SoFi and you're interested in selling put options, stick around and watch because I'm going to jump in right now. All right, here we go, everybody. Lee Lowell here from smartoptionseller.com. So we're talking about selling put options on SoFi today. And in the cheat sheet, which you see in front of you, a little bit of a background on SoFi, why I like it so much, and the specific methods that we use at the Smart Option Seller when we sell a put option contract. Now, I just want to say up front, what we will be talking about today is not a real trade. It is not a recommendation. This is just what I'm doing with SoFi, thinking about doing with SoFi, but it is not a recommendation. It is an example only. I got people commenting to me in the comments here, and they're always asking me, well, why are you doing this on that stock? Why? And it's only an example, okay? Even though I do like it and I am personally doing this on SoFi, this is not an actual recommendation, okay? So just so we know. But in this cheat sheet here, I will show you our method, the way the criteria that we use at the Smart Option Seller, which is purely focused on the educational. These are super, super conservative type of trades because I want all my students and all the viewers to know that I want to teach this method of selling put options in a very conservative manner, less stressful, so you can understand how the strategy works without being concerned about the stock dropping so much on you, okay? So if you look at the numbers I'm going to show you, you're going to think, wow, that's kind of small, but it's done for a reason, okay? So let's just talk about SoFi, and then we're going to look at the example. The reasons why I like SoFi so much is, for me, is how it looks on the stock charts. Selling put options is a bullish strategy, or at least a flatlining stock type of strategy. It's a bullish to neutral strategy. So if you want to sell put options on any stock, you have to be somewhat bullish on the stock, and you want to see that stock in an uptrend on the charts. Okay, we're going to look at the charts. We're going to look at SoFi on the charts and show you why it's in a great uptrend. You can see right here, follow me here. It's in a great uptrend on the charts. They have great financial products. They're, online banking. They have great online financial products. They're going to be stepping in the U.S. at least. If the federal government stops, giving out money, lending money, SoFi says they're going to step up. And also, SoFi right here, top here, SoFi is in well-demand stock, okay, which means it has a lot of momentum. It's got great support from the bullish crowd. So it's keeping the stock in an uptrend. Sometimes that's how it works. There are lots of people out there, especially SoFi. It's a lower price stock, so a lot more of the retail players can get into the trade, okay? So let's just take a look at the stock on the charts. I'll come back here and I'll show you what we look for, our criteria when we sell put options, and then we'll look at the option chain and everything else. All right, so let's take a look at the charts. Here is a daily chart of SoFi, okay? About a 2-year look back period. Here's the chart, the price action up here. Here's the RSI that I use, and I got 3 moving averages. I got a 20-day, 50-day, and 200-day simple moving averages. That's all I need. Keep it simple. Now you can see SoFi up until about a year ago was pretty much flatlining near $8 a share. And then it got caught wind, started to go up, had that little pullback in April when everything pulled back this year. And then it's just gone on this tear higher since the lows in April, about $9 a share, got up to a little over $32 a share in just, the last few months from April. You can see how it's kind of hugging along either the 20-day moving average or bouncing off the 50-day moving average and the 200-day moving averages down here. When you have a stock that's in an uptrend like this, you can see it's in an uptrend. It's hugging along the moving averages, and all the moving averages are sloping higher, which also means it's in a nice bullish uptrend. it's going to stay in that uptrend until something really comes along and pushes it in the other direction. With so much bullish momentum out there, SoFi is here to stay for now. Okay, it's getting a lot of buzz. People like it. It's a lower price stock, under $30 right now. There's a lot of participation from the retail crowd, which is great. And so I also like it because it's hovering around the mid-range of the RSI. So it's staying in the uptrend. Now, what we like to do is we like to try to play in between earnings announcements. So every company listed on the U.S. stock markets has their earnings every 3 months. So we like to try to take a position in between that period. We don't really like to hold a position over earnings announcements because you never know what might happen to the stock. So for now, SoFi is in a nice uptrend. If you are bullish on SoFi and you think, okay, I want to get involved with SoFi, what can I do? Well, what we do is we sell put options, and we sell very conservative put options. One of the criteria that we use here at the Smart Option Seller is that when we sell a put option, we like to choose a strike price, which is 20% below the current price of the stock. So if SoFi is kind of near $30 a share, 20% of that would be about a $6 strike price below that. So we're looking at maybe the 24 strike, which is about a 20% cushion below the current price of the stock, maybe the 23 strike, whatever you want. Okay, we use the 20% method, but in this video, I'm going to show you how you can go even lower than that. Now let me just take a step back and talk about what selling put options is. When you sell a put option on a stock, you do not have to own that put option first. You can just sell that as your initial transaction. And what you're doing is you're going to get paid upfront for the sale of that put option contract. And what that put option contract does for you as an option seller is that you're obligating yourself to potentially buy 100 shares of that stock at the strike price that you've chosen sometime by the expiration date. Okay, so if we sell, let's just say, a 24 strike put option on SoFi, we're obligating ourselves to potentially buy 100 shares of SoFi at $24 a share at some time in the future. But that'll only happen, we'll only be obligated to do that if SoFi actually falls down to $24 at that time of the expiration. It's almost at $30 right now. So it really has to fall pretty good for us to have to be obligated to follow through with our obligation. And if the stock doesn't fall down to the strike price, well, then you don't buy the shares, but you get to keep the upfront payment that the put option buyer paid you. All right, so we're going to look at the example, and we're going to see what kind of money you can get, how much money it takes to actually put on the trade. Now, remember, when you sell a put option, you're either going to have to put up the full cash. Let's just say if your strike price is $24, you're going to have to put up $2,400, kept aside in your account. And that's called what's trading in a cash secured. That's called selling cash secured put option. You'll have to hold the full $2,400. Now, for me, I don't like to put aside the full amount of money if I don't even know if I'm going to buy the shares at all. I don't know that. No one knows that because we don't know where SoFi is going to be at expiration. So I don't want to put up the full amount of money before that actually happens. Okay, so there's another thing where you can trade in a margin account where your broker will only hold aside a certain percentage of that $2,400. Typically, somewhere between 10 and 20% of that $2,400. I'm going to show you what in the brokers in the option channel. I'm going to show you how to see how much money that is. I like to use my money a little bit more efficiently, so I trade in a margin account. Okay, so SoFi is trading a little bit under $30. Let's take a look at the option chain now and see what kind of money we can get by selling some SoFi put options. Now, here's the option chain. We got put options on the right, call options on the left. We're going to look at the January 16, 2026 expiration 75 days from now. Now, SoFi just announced their earnings not that long ago, so the next earnings announcement is after this expiration date. So if we trade these January options, we're going to be in the clear. The earnings announcement is after that, okay? So what we're going to look at is here, SoFi $29.63. As I said, if we go about 20% below that, you're looking at the 24 or 23 strike put options. But we're going to go a little bit lower than that. We're going to be even more conservative. And if we go back to the chart real quick, we can see the 200-day moving average is right around $18.56. So we're going to look at something just above it. We're going to look at the $19 strike price. So SoFi would have to fall over $10 a share before we would even have to consider fulfilling our obligation and buying 100 shares at $19 a share. That would be a great spot to potentially buy SoFi if it pulls back and you're still bullish on the stock. Remember, you have to be bullish. You have to want the stock, and you're going to be willing and able to pay the full amount at the expiration. Okay, so let's just assume you can meet all those requirements. Let's take a look right now at the $19 strike price right here. So it went out on Friday, 23-cent bid at 42-cent offer. SoFi rallied in that last half hour of the day. I'll show you that on the charts as well. But let's just assume you can sell this thing for about 32 cents a contract, which is 32 actual dollars you'll get in your pocket. Now remember, these are very conservative. These might be smaller numbers than a lot of you might want to receive. But as I said, it's done for a reason. So let's just assume you can get $32 for every contract you sell. Last price was at 37, but we'll look at the chart the last half an hour. SoFi went up. So these put option prices fell down a little bit. Okay, so when stocks go up, put option prices go down. So let's assume you can sell something right here in the middle, 32 cents a contract, and that means you'll get 32 actual dollars in your account. Now, in order to see how much money it'll take to, if you're using in a margin account, I'm going to show you how much it'll cost you. Not actually cost, just some money held aside. If you're using a cash account, you'd have to hold aside $1,900 a share. So let's click on the bid. It's going to fill up a line here. This is called the order line. And we're going to put in 32 cents as our potential sale price. And we're going to click on check margin. So here's the box that would come up that shows you how much money your broker is going to hold aside while before you actually execute this trade. Here's where you want to look right here. Well, before that, I'll show you. You're going to sell one contract of the SoFi 19 put for January 2026, and you're looking to get a credit of 32 cents. Now, if it's filled, if you're executed, you'll get $32 minus the commissions. Over here, it tells you how much your broker is going to hold aside in order to execute this trade right here. It says initial margin is $328. So before the trade, you had a zero margin collateral being held aside. After the trade, you're going to have $328 out of this. This is a fake money account, paper trading account, which you all should use if you've never done these trades before. Out of this $1.17 million account, here's what you're going to have after the trade. A little bit less money. Actually, you'll get a little bit more here because you'll get your $30. So your account will go up by about $30. But you're going to have to hold aside $328 out of this $1.17 million. Only $328 versus $1,900 if you're using it in a cash account. So let's do this in real time together and see how much that would be. Now let's just assume that the trade expires worthless. You keep the full $32 because let's just say SoFi didn't fall down to $19 in the next 75 days. You get to keep the full $32 because SoFi is not falling that far. Most people want to know, well, what's my return on the trade? If I have to hold aside $328, what is my return? It'll be your return on margin. So $32 divided by $328, that's a 9.7% return in 75 days on that margin hold. Okay, if you want to annualize, let's go out and see what that would be. Times 9.7. So we're looking at roughly a 47% return annualized if you can do this trade, roughly every 75 days. Now, if you're using a cash account, you're going to have to hold aside $1,900. So your returns are going to be a little bit less because you have to hold aside more money. But let's see how much in that, if you're using a margin account, if you have to hold aside $328 divided by the $1,900, now you're looking at, that's about a 17% margin requirement. That's what it's called, margin requirement. So out of that $1,900, your broker's only asking you to hold aside about 17% of that, which is this $328 amount. So for me personally, I like to trade in a margin account because less of my money is being held aside. Now, if SoFi does fall down to $19 per share and I have to fulfill my obligation, then I have to come up with the balance of the $1,900. I have to put up $328 first, and then I have to come up with the rest of the $1,900. That's how it works at expiration if you have to fulfill your obligation. Just remember, you're going to be happy to buy 100 shares at $19 per share. So you'll be happy to pay the full $1,900 at that time. Okay. Now let's assume that you don't need to be that conservative. You want to be a little bit more aggressive. Then you can sell the true 20% level. That'll take you down to, let's say, the 24 strike, where you can get roughly $1.15 per contract, which is actual $115 in your account. So instead of getting the $32, now you're looking at $115 if you sell this one, the 24 puts. But SoFi has to fall a little bit less, just down to $24 versus falling all the way down to the $19. So you have to decide, how aggressive do you want to be in your potential obligation? Do you want to potentially buy SoFi at 24, or do you potentially want to buy it at 19? That's up to you. Only you can make that decision. If you're like, I like SoFi right where it is, around $29, you can sell the 29 puts for over $300, about $305 you'll get. So it's all depends on, what your risk tolerance. The higher in the strikes you go, the more money you will receive. Okay. Now, if you go further out in time, let's just say you go out till next June, let's just say, and you sell those same 29 puts, now you're going to get over $500 and something. So the further out in time you go, the more money you get. But do you want to play within those earnings announcements? Like I said earlier. So it's entirely up to you. Now the next question becomes, what kind of probability does SoFi have from falling from 29 and change all the way down to $19? The options game is all about probability. It's all about how does a stock move, or what's the probability of a stock moving from point A to point B within the time allotted, which is the expiration date. So that's when we can use our trusty probability calculator. Let me bring up the probability calculator. This is something we have on our website. So let's just put in, 2970 for SoFi, and we're looking at January. These are the input numbers. So January 16th, see 75 days. The future volatility of SoFi is probably about 65%, and I'll bring up the volatility charts and show you how you get that. Now, when you're using a probability calculator, the inputs are up here. All the inputs up here are gonna drive the outputs up here. So all the outputs down here, I should say. All you want to know is, what is the probability of SoFi going from $29.70 all the way down to $19? We're going to put in both boxes because all we care about is one level, which is $19. What is the probability of SoFi falling over $10 in the next 75 days? And we click on go. So you can see here, this box here and this box here. There's about a 6.47% chance that SoFi could finish below $19 at expiration in 75 days. Conversely, over here, there's only a 93.5% chance, there's a 93.5% chance that SoFi won't fall that far. So if you want to be super conservative on these trades, if you're like, I just want to sell SoFi to get the money, I'm not really so interested in buying the shares, then you want to choose those lower strike prices because they'll have a much higher probability of the stock not falling to that level. Now, if you use the 24 strike price level, your probability is going to be a lot higher that SoFi could fall that far. We click on go. So now there's a 23.47% chance that SoFi could finish below $24 in the next 75 days. And there's more of a chance that you're going to have to buy your 100 shares. But that's entirely up to you. So you choose, what's more important to you. Do you want less of a chance of getting assigned? That means that you'll have to buy the shares. Or do you want more of a chance? The less chance there is, the less money you receive. The more of a chance of you getting assigned, the more money you get. So you have to figure out what works for you. Okay? Now, based on the stock chart, SoFi's in a pretty good uptrend, and it's probably going to stay in that uptrend. You got a lot of people that are bullish on the stock. So most likely, SoFi's not going to fall that far. Here's our strike price all the way down here, just above this 200-day moving average. The 24 strikes here. You get 1 or 2 bad days on SoFi, it could possibly fall that far. So it's entirely up to you with what you want to do with it, okay? So, all right, so let me show you where you can get those probability numbers to, or the volatility numbers, I should say, to put in the probability calculator. If you go to a website like, I show this all the time, optionseducation.org. Okay, optionseducation.org. You can see in the address line up here. Open yourself up a free account and you go to their volatility charts. Okay, you'll be able to see it. It's in their free tools. This is all free information. Now, this is what's called a volatility chart. They have two lines. They got the historical volatility 20-day look back period, and they have the IV 30-day forward looking type of number. Now, what does that mean? Historical volatility tells you the actual fluctuations of SoFi over the past 20 days, and it's a rolling 20-day moving average. Okay, so that would be this line down here, the bottom line. The IV30, which is called implied volatility, is the option market maker's best guess of how SoFi is going to fluctuate in the 30 days moving forward. So typically, most of the both lines typically follow each other. But right now, here's the most current date as of October 31st, which was Friday. And the one line was at around 70%, and the other line was around 62.5%. So average in the middle, I'd say, roughly 65, 66%. And when we put in the probability calculator, I used about 65%. That's what you put in this box, future volatility. Now, you can use either the historical or the implied. Most people use the implied volatility number, or you can take an average of the two of them, whatever you want. Or you can just use the higher one, because that'll give you more of your worst case scenario. Okay, so that's what you put in this box, and then you put in your target levels, and then you click on go, and it gives you the level. So we have this on our website. So I wanted to show you where to get those numbers. Let's go back to our cheat sheet real quick and talk about where's my cheat sheet here. Okay, so let's just once again go over this. Here's our method. 20% buffer between the current price, stock price, and the strike price. We look for a premium collection of 25 to 30 cents per contract. That's actually 25 to 30 actual dollars that you'll get in your pocket. Okay, we want to use the shortest expiration date that meets the criteria of these two up here. And you want to play within earnings announcement. Okay, so this method, by using this very conservative method, allows for probabilities of profit, which is what shows on the calculator. We had about a 93.5% probability. But a lot of times when you use these parameters, these three parameters, you can get around that 95% probability that the stock is not going to fall that far. And when the stock doesn't fall that far, you just keep the cash, the $32 in this case. Then you do the trade again for the next couple months out in time. And you collect that cash. If the stock doesn't fall down that far, then you do it again. So you can churn out this continual collection of money from whatever stock you're looking at. Now, you can do this on any stock that you're bullish on. Selling put options is a great strategy. As long as you're bullish and whatever strike you choose you're comfortable with, then go for it. That's up to you. And this is what it's all about, slow and steady hitting singles. We're not swinging for the fences. We're not buying out of the money call options, trying to figure out where the stock may go to. All we're trying to do is figure out where the stock most likely is not going to fall to. If SoFi's at 29.5 or so, we're estimating that it's not going to fall down to $19 in the next 75 days, and that gives us that 93.5% probability or so. And if it does fall that far, well, then we get to buy our 100 shares at $19 a share, and that's something that you would be comfortable with because you're making that decision ahead of time, all right? And once again, this is example only, not a real trade. And just remember, these premium collections is because we're super conservative. My goal is to teach everyone how to do these trades in a less stressful manner. This is how we do it. And when you're more comfortable, then you ramp up your risk and use a higher strike price, okay? All right, well, that's it for this lesson today. I hope this has been helpful. Let's go to our website real quick, smartoptionseller.com. If you want to learn more about put selling, there's a couple resources I have for you here. Free ebook right here. Click on this, Put Selling Basics. You can get this. We'll send you an email. You go down and you're going to put your name and email in the box, and you'll get a link for the free copy. If you want to take a deeper dive into what put selling is all about, you can look at our video series, 5 hours of instruction, all about selling put options. In addition to that, you get 30 days free access to our put selling newsletter where we actually make trades. We sell put options just like I showed you, and you get 30 days free to the probability calculator. What else we have on here? Here's our services tab. This shows you what we do on a regular basis. We have two newsletters. One is the put selling, like I've shown you here. We have our put option credit spread newsletter. We have our one-on-one coaching. If you're new to this game and you need a little hand holding, you want to learn more, consider a one-on-one coaching session with me. Click on that link, and we have our probability calculator. If you just want to get the probability calculator, click on this link right here. I'm going to put links to those as well below the description in this video. Please read down in the description below. I've got links and books and software and websites for you that can help you as an option trader. I make these free videos usually once a week, trying to help everybody out, passing on my 30 plus years of education in this business. Leave me a comment, leave me a like. Please, I'm trying to get to my next level of 50,000 subscribers to this channel. Trying to get the message out there, all for free here, okay? So help me out. Send me an email if you have more questions. I'm always here to help. That's it. I'll see everyone in the next one. This is Lee Lowell signing off.